From glamour to caution, why investors are retreating from the luxury market. Significant shifts, including changing consumer values and geopolitical uncertainties, are making investors nervous about the luxury industry's future. All luxury brands are affected by important changes, of which only a select few are ready at present. Some investors are now approaching the luxury sector cautiously, partly due to these changes. First, shifting expectations and ideals among consumers. Presumptive consumers are showing a preference for sustainable, ethical businesses and are increasingly prioritizing experiences over material belongings, particularly in younger age groups. At the recent Pepperdine Disruptive Luxury Symposium in Malibu, we spoke with ultra-high net worth luxury clients about this subject, and they told us that net positivity is their top worry. These days, very few brands even come close to meeting this expectation. This puts into question the conventional luxury paradigm, which is frequently based on ostentatious spending and resource-intensive production. Local brand tastes are also rapidly changing, particularly in China, where there is a growing appeal for local brands. Luxury brands risk losing market share if they can't quickly adjust to these shifting consumer expectations. Second, the unpredictability of world politics and the economy. Trends in the economy and world events can have an impact on the luxury business. Discretionary spending may decline due to persistent geopolitical tensions, the possibility of trade wars, and the unstable state of the economy. Europe has just entered a formal soft recession. Speaking with CEOs of luxury brands frequently, I observe a growing uneasiness regarding the quickly shifting geopolitical landscape, particularly a growing awareness of a possible over-reliance on the Chinese market. Third, the upcoming digital chapter. Fearing that digital technology will weaken brand exclusivity and prestige, many legacy players have been sluggish to adopt digital technologies despite e-commerce's growing significance in the retail sector. Even if the epidemic has compelled many organizations to make progress, there are still big obstacles in the way of a completely seamless digital-physical customer experience. Due to the possibility of losing market share to competitors that are more technologically adept, this gap in digital competence poses a serious risk to brands. These factors account for the current shift in the luxury market from glamour to caution, which has caused some investors to re-evaluate their holdings. CEOs of luxury firms must handle the rising expectations of investors in addition to mastering the operational problems posed by these changes. The luxury market has seen many ups and downs over the last year. Charles Gora, Reebok founder and CEO, weighs in on the first-hand luxury and resale market. Gora says that less spending in the first-hand luxury market directly impacts the resale market, noting resale retailers are a consequence of some of the trends that you see in the first-hand market. Gora notes the tension of softer demand, increased customer acquisition costs, more competition, and channels for selling, which leads some players being drowned out. The resale market is a reflection of the luxury market, and you kind of have to converse trends to two opposite trends in this market. If things slow down on the luxury first-hand market, it means there's more tension on consumers there. There are a lot of the far-fetched stories and international stories that you have to do with China and a lot of geographies that we're not directly impacted with. And frankly, they've had their problems of, taking the company in many, many directions. So I would say not directly related, said Gora. What is common is some of the tensions that you could call unit economics, right? And some of that is for the last 2 years, you have a combination of softer demands. Numerous combinations increase competitiveness. Numerous digital players are facing rising expenditures to acquire new customers. Additionally, there are more avenues accessible for premium businesses. The most recent Bain Alta Gamma luxury market analysis projects that the personal luxury category would expand by just 4% in 2023 at current exchange rates, against a backdrop where the global luxury market is expected to rise between 8% and 10% across all categories. This year, the entire luxury market is expected to exceed $1.65 trillion. Personal luxury products are expected to hold a quarter of the industry and generate approximately $400 billion in sales by the end of the year. This is a defining moment for brands, and the winners will separate themselves through resilience, relevance, and renewal, the fundamentals of the new value-centered luxury equation, said Claudia D'Arpizio, co-author of the research. However, D'Arpizio expresses cautious optimism, of the personal luxury goods industry in 2024, pointing out that fragile consumer confidence, macroeconomic tensions in China, and spare signs of recovery in the US could cause the sector to slow down from its 4% growth rate this year to something less. Furthermore, there is a chance that the disruptive changes in the global socio-political situation, which is a diplomatic way of expressing that everything is in jeopardy, will cause even more difficulties. While highlighting the robust foundations of the luxury market that offer luxury businesses unparalleled resilience, co-author Federica Lovato recognized on a call that there were numerous challenges ahead, particularly the apprehension of premium buyers regarding a potential slowdown in the economy. They're already holding off on making impulsive purchases despite their stable income and riches. She stated that the increasing convergence between products and experiences is the long-term development engine, that there are soft aspects in their willingness to buy which are equally relevant to the hard data about the number of people able to spend on these items. In the intermediate term and beyond, convergence among luxury markets will unleash further expansion, she stated. She characterized the convergence as personal luxury brands providing more experiences in store, opening eateries, lodging facilities, and other experiential venues, and romanticizing goods brands beyond the actual product to the emotions and experiences that come with wearing and owning it. In contrast, experiential businesses are growing to provide relevance over different episodes of the customers' lives by branching out into merchandise and retail. The evidence indicates an increasing polarization in the market that will distinguish the winners from the losers in the upcoming year, notwithstanding the existential rhetoric of convergence. Compared to the previous year when 95% of businesses saw growth, there will be fewer winners and more losers this year. Although 65% to 70% of brands are expected to report good returns in 2023, 35% of luxury brands were winners during the 2008 to 2009 global recession. With more individuals having the freedom to travel, there is a growing gap in what customers choose when it comes to having more experiences, particularly with luxury accommodations, cruises, and fine dining. There will be a 15% annual advancement in this area. Additionally, more affluent buyers are specializing in fine arts, high-end vehicles, private aircraft and yachts, premium wines and spirits, and gourmet cuisine, all of which Bain refers to as experience-based goods. This year, compared to last, experience-based items will grow by 10%, allowing luxury goods to make up the difference. Only 3% of luxury goods will increase this year. It will be fortunate if they remain unchanged from the previous year. This pattern of discretionary spending, rebalancing toward lived-in experiences, is attributed to normalization. Throughout 2023, the US luxury market has gradually slowed down. This is particularly troubling because, according to Bain Alta Gamma, the Americas are home to over 50% of the world's ultra-high net worth individuals. The Americas is the only geographic market that is declining, with a decline of 8% by year's end. And with Americans spending abroad contributing to Europe's 7% growth spurt in 2023, the Americas will lose their crown as the world's largest luxury market to Europe, which will bring in $112 billion in revenue to surpass $111 billion. When American customers continue to spend the most on luxury goods globally, 29% to 31%, and this will pose the biggest obstacle for luxury firms in 2024. That's all for now, thanks for watching. If you enjoyed this video and found it amazing, please don't forget to hit that like button below. And if you want to stay updated with more great content like this, make sure to subscribe to our channel by clicking the red button and ringing the notification bell so you never miss any future content from us. Your support means the world to us.